Greetings. Welcome to another edition of BankBeat's Quick Take Videos. My name is Tom Bengtson. I'm the publisher of BankBeat Magazine and BankBeat.biz, the daily industry news website. I'm joined today by Aaron Stoffer, Relationship Manager with Country Club Bank of Kansas City. He works in the Asset Liability Division and the Investment Division, where he is responsible for advising on things such as interest rate risk, liquidity risk, and overall balance sheet management. He's also involved in investment sales. Prior to joining Country Club Bank, Aaron spent 4 years with the state of Kansas as a state bank examiner. Hello, Aaron. How are you doing?
Doing well, Tom. Thanks for having me.
Great. Well, we're here today to talk about loan pricing, and the current interest rate environment makes loan pricing a particularly sensitive task. Aaron, what are your general thoughts about how a lender might approach loan pricing?
Great question. I mean, obviously, traditionally, loan pricing has been done based on a cost plus a spread. So our funding cost plus a credit spread, perhaps. But when times are when we have a lot of liquidity in the balance sheet, that loan pricing seems to be a little easier. We can be more competitive. But the challenges that we have today in loan pricing with our current funding cost really is making the decisions, the things that go into underlying spread, more important and maybe more visible when we have these tight liquidity stances.
And so, in addition to cost of funds, what are some of the other considerations that a lender might take into account as they're pricing credit?
Oh, sure. So with the spread, right? So cost of funds is whether you're using your internal cost of funds or if you are using a market-based type of pricing metric, which we recommend, because it's going to take in consideration the structure of a loan, whether the term and the amortization type of structure for a certain duration. But the spread component, we need to account for liquidity costs, right? So the opportunity of that pricing of those dollars in the market and the giving up of using those for something else. We need to consider credit pricing. So the impact of, what happens if a loan goes bad? We need to get compensated for that. But there's one key component that we often overlook, and it's the prepayment option, right? Loans typically, unless we have some metric in it, has an option on it that we as bankers don't control. And there is a value to that. So how much is that component made up into the credit spread or the overall total spread that we might be missing out on?
Right. And in order to be competitive, it's sometimes easy for bankers to be lulled into pricing loans too low. And I'm wondering if you find that bankers often are taking too much risk for too little reward.
Oh, for sure, and without a doubt, and we have these challenges here at Country Club Bank, right? And we constantly have the conversation at our outgo of, hey, we need to price this loan here because of competition down the street. If we don't price it this low, then we're going to miss out on this relationship. And we often don't look at alternatives uses of those dollars. So we look at things very siloed, very isolated, and not compare it to other assets, whether it's other asset classes, other loans, or other opportunities that we may have. And so, we're like, oh, well, we need this relationship. And if we don't price it this way, we're going to lose the deal. Sometimes losing the deal is a very profitable decision, right? So depending on what we do or how we have to fund new loans. And again, it goes back to our capacity. If we are out there trying to fund loans in the same market that we're making those loans, it really puts pressure on the spread and the price and the profitability that we get out of this individual deal over the life of that loan.
Yeah, and you mentioned the competitors, and it seems like in every market, there's a dumb competitor who's pricing credit really in an unsustainable way. And so bankers can't really count on competing on price. And so that kind of leaves competing on service or on other factors. And I'm
Mhm.
wondering if you have some examples that come to mind or some things you can think of that really exhibit outstanding service and provide the customer a reason to pay up a little bit to work with a particular bank.
Well, I mean, you look at kind of what's going on in the market today around the banking. The regional banks there's a lot of stress out there, and there's a lot of uncertainty. The bigger the bank, the more separated that relationship. And so, having your loan officer to be able to go to, and not necessarily a underwriting department or a credit department that's somewhere else in the country in a call center trying to answer any questions you may have. I mean, that in itself is a huge relationship build, and something that a lot of borrowers are willing to pay a little bit more for, having that convenience, being local, being able to walk in and having a face-to-face conversation versus, everything, all credit decisions done not by the person that they're talking to. So having that connection and the understanding of what's going on, there should be a value to that, and there should be, you know, that compensation for the local bank.
Yeah, very good point. I appreciate that so much. Now, at Country Club Bank, you've got a product called the Loan Drill Down Report that can really help lenders with loan price decision making. So tell us about that service.
Yeah, so actually, a couple things. We have the loan drill down report. We also have what's called a loan builder. The loan builder is an online based on our bankpath.com website. It's free for anybody to use. You can really see the inner workings of what goes into pricing a loan, and it allows you to understand the return on asset of that individual loan. In our loan drill down report, we often have performance metric reports on our bond portfolio. We constantly look deep into those, but how many of those performance metrics types of reports do we have on our largest asset class, which is our loans, typically for most banks? So the loan drill down report is something that we have available to our interest rate risk users, that they can subscribe to, and it goes and drills deep into the pricing and makeup of the loan portfolio, both at the greater bank level, all the way down through branch level, if you have regions, down into the loan officer level. So we can see who is pricing certain structures a certain way. And then something that we added here recently is a loan profit report. And it's backward looking. So it's not saying, hey, how do we price loans going forward? That's kind of what the loan builder tool is helping there to help you understand the pricing. But as we put all these loans on in the last year, what sort of impact is this going to have on our balance sheet going forward? Because we've already made the decision. And now if our cost of funds starts coming up, what is our month by month ROA on just our new business that we were booking, whether it's fixed, variable, and whatnot? So you can really see, are we doing a better job of pricing our variable loans, or are we doing a better job of pricing our fixed loans? And what is that overall impact to our bottom line? And when we understand that, and we can start seeing some trends in that, then we get more information to make better decisions on the loans that walk in today, right? So we need to assess how we've done. Are we making any changes, and are we tracking what that impact is? And so this report really does a good job of highlighting that, and seeing what, again, the longer term impact is, more than just today's profit.
Well, these boards I know can really be helpful, and they've kind of emerged in a lot of different areas. It's the first one I've heard of specifically related to loans. So I think that sounds pretty unique.
Mm-hmm.
Now, for somebody who's not familiar with that, then you mentioned the loan builder link, and that's available to anybody, right? I mean, maybe do you
Yep.
start there, take a look at that, and then see, and give us a little tutorial
Yeah.
about how to get to that and how to get started there.
Yeah, so bankpath.com, bank with a C, and in there there's a tools drop down, and in that tools drop down is our loan builder, and we ask for you to give us your name and email, but we don't send anything from that. It's just more for us to track to see who's using it. We have banks all across the country that access that. We have banks that aren't our clients that we see. They get on that. They use it for loan pricing for themselves. And it's again, it's not to say you have to price the loan this way, but what that tool is doing is saying, hey, here's the broader swaps market and how the swaps market would price a certain structure at a given credit. And so it gives us a starting point to have conversations in our loan committees to say, are we looking at this? Are we getting compensated for the risk that we're taking? Because credit spread changes, right, over time. And right now, with where we are at the top of markets, the credit market really is getting tighter, right? That means that the really good credits versus the marginal or not so good credits, there should be a bigger spread when we're down at the bottom of the market. Those spreads are generally tighter um, between that. So it's, now it's hard to find the bad credits because everybody is looking really good on paper, but there's a lot of risk that's boiling in this market that we don't know where it's going to show up. But you can bet when a recession comes, we're going to find out.
Right. Well, obviously having good information, being able to track what it is you're doing certainly makes
Yep.
decision making better, easier, more accurate. So sounds like a really worthwhile tool. So thank you. That's super interesting.
Yeah.
Now, if people want to follow up with you, get in touch with you, um, share your contact information, please.
Yeah, absolutely. It's on our website, bankpath.com. You can email me, or you can email. We have a generic AMG at countryclubbank.com email that if you send that, it comes to the entire team. We're happy to answer any questions on those tools. Give insight to what we think. Again, we are a bank first, so the questions that we have for ourselves and for our balance sheet, I'm sure everyone else has those same questions. And so given that unique standard, that position that we're not just out there saying, hey, this is a product we have. We use the tools that we have because we're trying to find answers in our balance sheet that everyone else has as well. So it's so my email is Stoffer, that's Astoffer at countryclubbank.com, or again, the AMG at countryclubbank.com. Our website has all of that information as well.
Well, we need to bring this to a close. Our guest has been Aaron Stoffer, Relationship Manager with Country Club Bank. Thanks again, Aaron, for being with us. My name is Tom Bengtson, publisher of BankBeat Magazine and BankBeat.biz website. This has been another BankBeat Quick Takes video.
Thanks, Tom.